Financial statements are reports that help people understand how a business is doing. They show how much money a company is making, how much it's spending, what it owns, what it owes, and how it's managing its cash. There are three main financial statements you'll see: the income statement, the balance sheet, and the cash flow statement. These three reports give different views of the business, but together they tell the full financial story. Whether you're an investor, a manager, or just learning finance, knowing how to read these reports is a key skill. Let's start with learning about income statement. The income statement shows how much money a business made or lost over a period. It starts with revenue, subtracts expenses, and shows whether the company finished with a profit or a loss. Income statement is also known as the profit and loss statement or statement of financial performance. It's the go-to report for understanding business performance. Let's break it down. First, we have revenue, the money earned from selling goods or services, then cost of goods sold, or COGS. These are the direct costs of producing what the business sells. Subtracting COGS gives you gross profit. Next come operating expenses, things like rent, salaries, and marketing. What's left is operating profit, also known as EBIT. Finally, subtract interest and tax, and you get net profit, also called the bottom line. The income statement is a key tool for decision making. Investors use it to assess profitability. Lenders use it to judge risk. Analysts use it for ratio analysis. Senior management and boards use it to track performance and guide strategy. And it's a mandatory part of financial reporting shared with shareholders and regulators. In short, it's not just about profit, it's about performance, trust, and accountability. The balance sheet is a snapshot of a company's financial position on a specific date. It shows everything the business owns, what it owes to others, and the value left for shareholders. It's also known as the statement of financial position because it reveals the company's stability and structure. The balance sheet follows a simple formula: assets equals liabilities plus equity, and it must always balance. The balance sheet has three parts: assets, liabilities, and equity. Assets are what the business owns, like cash, inventory, or equipment. They're grouped as current or non-current based on how soon they're used. Liabilities are what the business owes, like bills or loans. These are also split by when they're due. Equity is the owner's share in the business. It's what is left after all debts are paid. The balance sheet shows a business's financial strength, what it owns, what it owes, and what's left for the owners. It helps assess liquidity, debt levels, and long-term stability. Investors, lenders, and leaders use it to make key decisions backed by ratios like current ratio and debt to equity. It's a snapshot that supports smart, informed financial choices. The third and last statement we will discuss today is a cash flow statement. A cash flow statement shows how much money is coming in and going out of a business. It tracks real cash movement, not just profits on paper. This helps us understand if the business can actually pay its bills and stay afloat. It covers a set period, like a month, quarter, or year. In short, it shows how cash flows through the business. The cash flow statement is divided into three sections. Operating activities show cash from the day-to-day running of the business, like sales, wages, and supplier payments. Investing activities cover cash used to buy or sell assets, such as equipment or land. Financing activities include money raised through loans or equity and money paid out like dividends. Together, these sections show where cash is coming from and where it's going. Cash flow shows if a business has enough money to keep running. You can be profitable but still run out of cash if payments are delayed or costs spike. That's why it's called the lifeblood of a business. It pays wages, rent, and suppliers. Lenders and managers rely on it to assess risk, plan ahead, and make smart decisions. Good cash flow equals flexibility. Poor cash flow equals danger, even with profits. Let's take a quick look at how the three financial statements are connected. This is just to show the basic links, not the full detail or complexity. The income statement gives us net income. That number flows into the balance sheet as part of retained earnings and the cash flow statement under operating activities. The cash flow statement also adjusts for things like depreciation and tracks how cash moves in and out. These movements change what's shown on the balance sheet, like cash, loans, and assets. In short, the income statement shows profit. The cash flow statement shows cash. The balance sheet shows where the business stands. Together, they tell the full story. Financial statements work together to tell the full story of a business. The income statement shows profit, the cash flow statement shows movement, and the balance sheet shows position. Each gives part of the picture. Together, they provide the full view. Understanding them helps make smarter business and investment decisions. Thanks for watching. Keep learning with Kash Concepts, where we make finance simple, clear, and practical. Don't forget to like, comment, and subscribe. And follow us for more videos that make finance easy.